Ready?
Mm-hmm.
Yeah, I'm not good at clapping, Molly. I could do this. All right. Welcome back to the Behind the Well Show. I'm your host, Roger Abel. We've got Elias Randall back in the studio today. And spring's heating up. Market's volatile. A lot of things happening. And we're going to talk about a couple of different things, where the market's headed, but also some strategies on how to deal with a market downturn. And one of the things I wanted the listeners to know is we've rolled out our 2025 Guide to Navigating Volatility. If you're watching the show, you can see it. We've got a hard copy. It's a really nice magazine that we put together, but also there's a digital download if you are looking for this. It's 10 tips for long-term investors and the Guide to Navigating Volatility in 2025. You can go to btwellshow.com or premieriwm.com to get a copy of that, or click the link in the description as well to get the digital download. If you like to get the actual limited edition, I'm calling it limited because we only had a few printed. We're going to get more printed.
It's limited.
Hard copy. It's really nice. Elias, I walked in my office the other day, and I think I told you this. This was on my desk. I started flipping through it. I'm like, oh, who dropped this off for me? And then I realized, oh, this is the stuff Molly and I've been working on. She actually put it into like this awesome magazine format. It's ours, so it's pretty cool.
It is cool.
It's been really well received. I know we just launched it yesterday and we've had a bunch of downloads on it already, but it's just really good, case studies and examples of a lot of the things people are going through right now, the range of emotions that happen, especially when there's volatility. And, I think we kind of warned people a couple months ago that we expect this year to be volatile. And probably the next 4 years are going to be fairly volatile, mostly due to the stock market just really likes to have some direction and kind of know where it's going. And when we get talks of tariffs and all these other things that are happening in the world, it creates instability in the markets, and they're trying to figure it out.
Yeah, and I think the magazine's very, very timely just because of how the year has already kind of been going on, which I think investors in general need to get used to. Here's what happened, right? We have all this tariff talk, so now the market's repricing the risk of all the stocks, and it's pretty fast, right? To go from the all-time high, then we pulled back about 10%, which is a correction from the high. I mean, year to date, we're pretty close to even.
Well, as of filming the show, let's see. As of filming the show, Elias, year to date, the S&P 500 is down 2.43%.
Right, so the point I'm making is that's really not a reason to abandon any sort of investing strategy that you had in place. And the market's always going to have volatility. And I think what successful investors do in times of volatility, and I think what we've seen a lot of people do, is some people quit looking at their account, they stop opening their statements. Some people continue to look, but they don't make emotional decisions based on what's going on. And like, I'm just looking at a headline right here, and okay, so the 25% auto tariffs are going into effect, and General Motors, their shares have now dropped 6%. Okay, do those tariffs impact their business? Yeah, absolutely. They're still a very successful company. Will they figure out how to navigate this new challenge? Right? I mean, does anyone think General Motors is going to go out of business because of tariffs? It's every business has times where there's going to be new things, obstacles you have to overcome. And all the companies in the market, are they bad companies because we're maybe going to have some tariffs that'll impact some industries? I don't think so. I just think we've had a repricing, and the market's slowing down. It's not always a bad thing, especially for the people. It's a great buying opportunity. I mean, I know I'm still a buyer at this price. If it goes down, I'll still be a buyer at that new price too. So I think the magazine's pretty timely. And I hope the people that download it or request a copy and read it, I hope it helps you kind of build some confidence in your investing strategy.
Those are good insights. And I think the thing about tariffs they're here today, they could be gone tomorrow. And that's the real challenge with trying to time what's going on, right? People now, well, tariffs, market's going down, they're going to go try to time the market. It's not going to work. We talk about the statistical probability of timing the market in this magazine. They could all reverse course within 2 hours. Seriously, by the time we're done filming the show, it could be totally different. This show's not going to release for another week. Guess what? It could already be over by then. That's how quickly things are moving. But here's what I thought would be fun today. I'm a big fan of Tom Lee, FS Insight, and they had released an article that I thought would be fun to go over. It's called "Where's the Economy Headed?" And here's what 6 weird indicators show. So I read this. I'm like, well, this would be fun, a little lighthearted to talk about, some of the indicators out there that people may or may not have ever heard. So the Big Mac Index, Elias, was invented in 1986 by the economist, and it measures whether currencies are at their correct levels based on the price of a Big Mac across the world. And we have clients all the time that talk about the collapse of the dollar, the strengthening dollar, and all of these different things. But the economists rolled this measure out, and the US dollar's gained some strength since the presidential election. And, there are worries that the era of the US exceptionalism's over. Many investors are rotating into European countries, international countries. We've seen a spike in the international indices year to date. I think at one point the DAX was up 19%. And as a result of this, currencies in international currencies have actually strengthened. Okay. So The Economist says that today you need $5.79 to buy a Big Mac in America. They also said that you need $3.52 converted into yuan to purchase a burger in China. So less. The Mexican peso, Canadian dollar are cheaper than the dollar as well. But it's just kind of a good theory that The Economist talks about and says because Big Mac prices have risen less elsewhere than they have in America, some of this has to do with, changing currency and the changing landscape. But it's an index that people look to see whether, pricing of currency is all kind of levelized throughout different nations based upon the price of a Big Mac.
Well, and what's really interesting to think about, so the first McDonald's was opened in 1940. So in less than 100 years, have a product that's sold all over the world that you can even compare the price to. So, and I think that starts to highlight the economy now is so mature and robust, and the companies are so big. Like, isn't that in 1940, when they opened the first McDonald's, had you said, hey, in less than 100 years, one of your sandwiches is going to be sold all over the world, and it can be a measure of currency valuation. Well, they would have said, how is that even possible?
Right.
Well,
because they were just trying to make a hamburger.
Yeah, they're running a sandwich shop.
It's what's really wild about what you just said is, we have what we call the U.S. stock market, and then we have the international stock market, right? Let's just look at two different things. McDonald's is not just a U.S. company. Now, they're domiciled in the U.S. and they trade in the U.S. stock market. They're a global company. So, we've seen a massive discrepancy between U.S. stocks and non-U.S. stocks the last decade. I mean, massive outperformance by U.S. stocks. Well, it may be a massive outperformance by U.S. stocks, but a lot of those have exposure to international, tendencies and international biases that are out there. So just because you own a U.S. stock doesn't mean they don't have international flair, like you just talked about with with the Big Mac. The second indice or index that I thought was weird, unique, but kind of funny, it's called the lipstick index.
That's one of the makeups that will continue to sell even if there's economic slowdown. From reading this, as I understand, it's one of the cheaper products to buy, and it's like the last thing. I suppose the economy would have to really, really slow down before people would stop buying lipstick as a cosmetic product.
And one of the things I saw in this article, which, I don't know anything about makeup. I'm guessing you don't either. This is a mom thing, right?
Well, here's what I know. In a pinch, it can be used as blush or eyeshadow.
I learned something new every day. So there's a lipstick index that, can show, that people believe could show whether we have a slowing economy because people would buy more lipstick and less other beauty products. And, there are some of the beauty stocks, one main one, which I can't mention, but they're down 20% year to date. Maybe it is showing that there's a slowing economy, that people start buying more lipstick and less other stuff because it's multi-use.
Right. Well, and I think even, and not to get back on the Big Mac index, but I did read recently that McDonald's was not able to get their last price increase through. So they increased prices. They saw a drop in their sales. So they kind of found people's price point for their services. So then they weren't able to do another increase. So I think that is a signal of some economic slowdown. And I think with everything going on, I don't know. I think it's reasonable for people to expect we could have slowdown. We could have recession. Recession doesn't mean we're going to have chaos and a crisis, but we absolutely could have some economic slowdown.
I think the cost of McDonald's has gotten to the point where it used to be a value meal. Lower income, I can go here, I can feed my kids, feed my family for a relatively inexpensive amount. If you go
used to be relatively inexpensive.
Yeah, right. Use relative.
Seems expensive now.
If you that's where I'm headed. If you look at the price of a meal at McDonald's, I haven't been to a McDonald's in 5 years. I haven't. I don't go to McDonald's, but I'm guessing a meal is $11 to $13.
Oh, I'm sure.
Okay. Well, I can go to a local burger joint that has a cook back there and has a fresh patty. You know what I mean? It's not as highly processed, and get that meal for about the same amount. And that's probably why you mentioned they found their like pain point there where it's at, because people are like, well, am I going to go to McDonald's or am I just going to go get something that tastes better? Because, a McDonald's hamburger is not all that appetizing.
No.
It's quick. It'll work in a pinch. It doesn't taste bad. It just doesn't look great. All right, 3, hemline index. And I had no idea that the hemline of a woman's dress has correlated with rises or declines in the stock market.
So this one caught me off guard, because initially I thought, okay, when times are bad, shorts will get skirts will get shorter because less fabric to make them, but it's actually the opposite of what I thought when I read the headline. So apparently throughout history, skirts have correlated with rises and declines in the stock market. So the longer skirts have gotten, it's typically a declining stock market.
It's so opposite of what I'd actually believe. But it's funny also in here, they said, a little bit has to do with when skirts are in. Don't really know what it means for the economy, but it's a helpful fashion tip. But there's a skirt index and there's a correlation. So I don't know where we headed. Have you been tracking this?
The skirt index?
Yeah.
No, I never even heard of it until I read this article.
All right. The 4th is the men's underwear index. So we should know something about this.
This one I have heard of before.
Have you really?
Mm-hmm.
Elias, I hadn't heard of any of these until I read this article. That's why I forwarded it to Molly. I'm like, this will be kind of fun. How did you hear about when did you learn about the men's underwear index?
Well, I think I read about it in like 2021 or 2022, because it was a similar article to this. But so underwear sales, men's underwear specifically.
Well, back up. So just so you know, we're not pulling this out of left field. This was actually
Alan Greenspan.
Yeah, one of Alan Greenspan's favorite indexes to follow. Which, if you don't know who Alan Greenspan is, he was a former Fed chair from 87 to 2006 for the United States.
Yeah, and I guess it's a good indicator of consumer confidence. Basically, the gist of it is men will stop buying underwear when consumer confidence is going down. So they'll just continue to wear the ones that have a couple little holes in them, and makes sense, right? No one can see your underwear, so you just don't buy any and wear that same pair. But that's I always laugh when I read about this one because, to me, okay, so like the indicator for consumer confidence in women was, okay, lipstick sales will increase, but they're taking a product and figure out a way to use it a couple different ways. Men just quit buying underwear.
They're like, we're good. Well,
I have 7 pairs. I don't need any more.
Here's why I really want to know, Elias. Is there a rotation from Under Armour to Hanes? Right? Because
I'm sure. I'm sure the first thing you see is a slowdown in the higher end.
You go to Dick's Sporting Goods and you go pick up a pair of boxer shorts. It's like $30. You can get a whole pack or 4 packs of Hanes for way less than that. I don't buy those, but I'm sure if you had to, you could. So that's actually a fun one that, you apparently knew about. That's awesome. The 5th is the Dr. Copper, and it's basically tracking copper prices. And the reason I do this is copper's used in lots of different things. In normal market conditions, a lot of times they argue that higher copper prices bode well for the economy, which we have seen a spike in copper prices. But some of that is due to some of the tariff talks and different things that are happening.
And there's some supply issues right now too. So there's an economist in this article saying that a lot of the price increase is really more supply constraints than it is the utilization of the copper, which I think is understandable, right? Because I think everyone would agree we don't have are we in a time like before the pandemic when the economy was really hot and clicking? We're not in that type of time right now.
Yeah, I think, we've talked about it. I think there's a tale of two economies. There's one section of, families in America who are doing fairly well. And there's another section who've kind of been left behind because of the rising price of costs and the lack of assets that they own.
Well, and that problem's going to persist.
Yeah.
Because it's the wealthy people, the people that have all the money, their wealth has grown significantly. Not just the last 5 years, but the last 25 years.
So the last one we're going to talk about, and I actually think this is a pretty good predictor. And I'm going to talk about a couple of reasons why, but it's called the Cardboard Box Index. Okay.
It's a good indicator of goods moving around, right?
Right. Well, if you think about it, our economy has switched from we used to go to the shopping center or a catalog to order our goods, right? To now we buy everything online. Buy everything online. So arguably, if we're buying all these goods online and more people are adopting online shopping, cardboard boxes should be used more. That's how they ship almost everything except for, some of those little bags.
Yeah.
It's actually estimated
80% of non-durable goods are shipped in a cardboard box.
There you go. So
it's almost all of them.
Yeah. So what is non-durable? That's like everything except your toothpaste, like the stuff you do on a regular basis, they're going to put in a cardboard box. Although I would argue I ship a lot of my durable goods in a cardboard box because I ordered deodorant from Amazon and toothpaste, and because it's a little quicker to get it than me go to the store. Anyway, it's considered a leading indicator, though, of manufacturing, of the manufacturing economy, because you have to ship goods. And, the data that we have suggests that the economy, the packaging economy, has been stuck in a rut since 2022. It just hasn't really gone anywhere. And, we're starting to see the impact of parcel deliveries. Some of the biggest delivery companies have lowered their full year profit and revenue outlook to reflect less shopping. Some of these companies are down 20%, their stock price year to date. So these are all some indicators that we can look at and say, hey, what do we believe the economy is really doing? And as you mentioned, we believe it's slowing down. And that doesn't mean it's necessarily a bad thing. It just means it's not red hot on fire like it was in 2021 and 22.
Yeah. And, with some of the bigger, like postal service companies, they lowered revised their earnings, and that's probably a good indicator, right? That's their indicator that, hey, we're forecasting lower sales, right? So that's less stuff moving around if they're making less money. And I think that's for investors. I think as long as we don't have, people have been talking about an earnings recession, as long as we don't have like major negative earnings for the companies, we can still have like an overall economic slowdown, or GDP could be flat to little, maybe even a little bit negative. But I guess at least the bigger concern, I think, for most people with the stock market, the institutions and really people that follow it, is like how are all the earnings calls going to be and all the guidance that they're giving. Because earnings recession, that could definitely lead to more selling in the market.
Well, also, you made a point that you mentioned earnings, and I think people should understand that the way stocks and the stock market is priced is all based off of future and expected earnings. And one of the reasons we see volatility in the market is because when there's tariff talk or changing policy, it's much more difficult to predict the earnings. And I think when people kind of understand that, that's what causes the volatility. When people understand the cause and effect, they become more comfortable about it. Like we talk about, people understanding why they have a portfolio, because we've quantified the risk capacity and showed them that this provides the highest probability of success. If people grasp the idea that stock market volatility is driven a little bit by uncertainty, and the uncertainty right now is, if we do X, what happens to earnings? That's why we see these quick reprices, because these companies all of a sudden have to reprice their earnings, or the stock market does, to predict the future stock price. And that's really why the stock market is for a long-term investor, not a trader. Like that's why we talk about long-term, because we don't know what's going to happen in the short term.
And we could, even though I feel like there's plenty of reasons, and there's good and I think reasonable reasons to believe we will enter some sort of economic slowdown, or maybe we're going through it. But how long is it going to last? Right, and that's what no one really knows.
No one knows. And it could be 2 months, it could be 2 years. Nobody knows.
And if all of a sudden, okay, now we can lower interest rates more because we got inflation where we need it to be. And so we can loosen monetary policy, and companies continue to make good money, right? You don't want to. You also, I know everyone wants to avoid any pullback in their portfolio. On the flip side of that, you also don't want to miss the beginning of the rally either. And if you could time it perfectly, that's what everyone would do it. But
the way to time it perfectly is just dollar cost average. Buy some at the low, buy some along the way, and just let it work out over time.
Right. And keep your money designed for growth. Just keep it invested. Stick with your, how investors are rewarded for sticking with their strategy over time.
It's the exact reason, Elias, that we've developed that bucket strategy. That's how to protect your portfolio. It's really simple. How do you protect your portfolio? You put together a bucket approach, which we talk about. We have a whole outline in this volatility guide about our bucket approach. So if you're looking to get some insight on how we do that, you can go to btwellshow.com. You can click the link in the description to get a copy of this. You also could go to premieriwm.com to get a copy. But let's talk about why we believe that bucket approach works. And it's simple. I think you would agree. Well, let me just ask you, what do you think the most important strategy for someone taking distributions is?
Well, I think they should have a bucket strategy, and
A bucket strategy. What's in those buckets? What's the most important
part?
component?
To me, the most important component in the short term is your liquidity, like your cash and your cash alternatives. Because in investing, we talk about sequence of returns, right? So the market goes down, you don't want to lock in a loss and sell an investment that's down in value to provide your monthly paycheck. Well, for us and the way we do it, if you can eliminate sequence of returns by having some cash and cash alternatives, and just the other day I walked someone through because they had some concerns, and I walked them through how their portfolio is constructed so they can take money out. And then I said, so all the money that's fluctuated recently, we're not planning on spending for at least 6 years. So are you still concerned?
Yeah, Elias, I 100% agree that cash bucket is what provides predictability and stability for retirees or people approaching retirement to not worry about what's really happening with the stock market. And, we load that bucket up with 1 to 3 years of cash that they plan on spending. And the math behind that's pretty simple. The average bear market recovery is a little over 300 days. The longest bear market recovery since 1950 happened from 2007 to 2010 is just over 900 days. So the reason we do that, it's really to weather the storm. Bad stuff happens, great. We can just wait it out. We have enough cash to sit there, and it's a little bit easier to have more cash there right now, mostly because you can earn a fairly decent interest rate. Right? And cash could be really short-term bonds, cash alternatives, stuff that you can get liquid and doesn't have a big price variance over time.
Yeah, I think the other thing, so in the short term, the cash bucket helps keep you in the game, right? Because you got your spending money. I think the flip side of it, and the other reason it's so important, is it should allow you as an investor to keep your growth bucket invested the way it should be. And investors that just totally abandon the stock market over the next 10, 20, 30 years, you will get a mediocre result compared to what you could have gotten if you keep your money invested. And once people get all the way out, right, especially you talk to market timers, well, I think now's the time to get out. I would really caution anyone from doing that, because once you get all the way out and then you've decided that's not for me anymore, it's much harder to get back in. And the most successful investors, they keep their growth bucket invested that way for long-term growth. And if you have a long-term outlook, right, when we're talking with some of your money, not all of it, especially if you're retired and living on it, that's your future hedge against inflation. That's how you're going to have years that are really good years in your portfolio.
Well, and I think the thing to recognize too, the financial plan, the risk capacity component, and the bucket strategy has to work as one cohesive unit. You can't just do one without the other. It doesn't really work. You can get a result that won't be optimal, right? But if you work with all of them together, it's just going to provide a lot more financial clarity, better sense of direction. It's going to help you manage your own personal volatility. Like, people have mind volatility, right? They do. The stock market's getting crazy. I feel more volatile in my thoughts about the stock market as well. And that's really what we do for people, is we put together a game plan to help you manage your emotions and all those feelings that everybody's going to have about different stock markets and what's happening. Like I said, I encourage everybody to go get this download. It just released a couple of days ago. You can click the link in the description. You can go to btwellshow.com, click get started, or get the download for this. Also, if you want to go to premieriwm.com, it's available there. With that said, Elias, I want to thank everybody for listening. If you're enjoying the content of the show, do us a favor, subscribe to our channel, our podcast, or our YouTube channel. Elias, do you have any closing thoughts for today?
Nope. Thank you for listening. Download the volatility guide.
I got to hold it up one more time because it's a pretty impressive magazine.
It's pretty cool.
Molly, this is your best work yet.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets.